Ever wondered what a hedge in finance is and how it works? Well, it's not as complicated as it might sound. In the world of finance, to hedge is to take an offsetting position in an asset or investment to reduce the price risk of an existing position. Simply put, a hedge is a trade made with the aim of reducing the risk of adverse price movements in another asset. This typically involves taking an opposite position in a related security or in a derivative security based on the asset to be hedged. Now, you might be wondering, what are these derivative securities? Well, derivatives are securities that move in correspondence to one or more underlying assets. These can include options, swaps, futures, and forward contracts. The underlying assets, on the other hand, can be stocks, bonds, commodities, currencies, indexes, or interest rates. Hence, derivatives can be used to set up a trading strategy where a loss for one investment is mitigated or offset by a gain in a comparable derivative. Think of using a hedge as taking out an insurance policy. Imagine owning a home in a flood-prone area. You'd want to protect that asset from the risk of flooding by taking out flood insurance. You can't prevent a flood, but you can plan ahead to mitigate the dangers if a flood occurs. However, it's important to note that hedging isn't free. There's a risk-reward trade-off inherent in hedging. While it reduces potential risk, it also chips away at potential gains. Just like with the flood insurance policy, the monthly payments add up, and if the flood never comes, the policyholder receives no payout. Yet most people would opt for that predictable, circumscribed loss rather than suddenly lose the roof over their heads. In the investment world, investors and money managers use hedging practices to reduce and control their exposure to risks. To hedge appropriately, one must use various instruments in a strategic fashion to offset the risk of adverse price movements in the market. This involves making another investment in a targeted and controlled way. But remember, unlike the flood insurance case where the policyholder would be fully compensated for her loss, perhaps less a deductible, hedging in the investment space is both more complex and an imperfect science. So, in a nutshell, hedging is a risk management strategy used in limiting or offsetting probability of loss from fluctuations in the prices of commodities, currencies, or securities. It's about strategically using instruments in the market to offset the risk of any adverse price movements. In other words, investors hedge one investment by making another. However, it's an imperfect science, and while it can reduce potential risk, it can also reduce potential gains.